Hey, it's Darius and it's Black Friday time. So take advantage of the best savings of the year while they last. There's never been a better time to go to i75cpareview.com. Whether you want CPA review, EA, or CMA, get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. No coupon code needed. Go to i75cpareview.com right now while the Black Friday special lasts. And if you want CPA review, click Get It Now. And then you can choose between the full course bundle, all parts, for 36 months. If you only need 2 core parts, then click where it says Get Started and choose one of our CPA review 2-part Black Friday specials. If you're looking for the enrolled agent Black Friday specials, use the top menu bar. Same for CMA. So whether it's CPA review, EA, or CMA, get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. Now we're going to look at transaction effect on liquidity ratios, because the exam expects a candidate to know how transactions impact certain ratios, like the current ratio, which we know is total current assets divided by total current liabilities. Now the exam might say that the current ratio began at 2 to 1, which means $2 of current asset for every $1 of current liability. And then here's the transaction. The company borrowed cash. Well, if they borrowed $100,000 cash long-term by selling bonds, then cash increases, that's a current asset, and long-term liabilities increase. Now the increase in cash is an increase in current assets, and that would increase net working capital, which would also increase the current ratio. Why? Because the numerator of the current ratio, current assets, is increasing with no impact on the denominator of the current ratio, which is current liabilities. And as the numerator goes, so goes a ratio. So this current ratio is going to increase as a result of this transaction, borrowing cash long term, because the numerator is going up and the denominator is not moving at all. And they could ask you a question like this. A company's current ratio started at 3 to 1. The company borrowed $200,000 by issuing long-term bonds and receiving cash. What is the effect on net working capital and the current ratio? A says net working capital increases, but the current ratio decreases. Well, let's take net working capital first. Net working capital is current assets minus current liabilities. And if we're taking in cash of $200,000, current assets go up. And then what about current liabilities? No, we're borrowing long term. So there's no impact on current liabilities. So net working capital does increase. But then it says, but the current ratio decreases? No. The current ratio would increase because numerator up, ratio up. And there's no impact on the denominator. So as that numerator, current assets, go up, so does the current ratio. So A is half right and A is half wrong, which makes A the wrong answer. Let's look at B. Net working capital remains the same? No. Net working capital increases. B's out. C, net working capital increases and the current ratio remains the same? No. So it must be D. Net working capital increases and the current ratio increases. Letter D is correct. Net working capital is calculated as current assets minus current liabilities. Since the company is receiving $200,000 in cash, that's a current asset. Current assets up. But the issuance of long-term bonds does not affect current liabilities, so net working capital increases. Now, as for the current ratio, we said current assets divided by current liabilities. Since current assets increase and the current liabilities remain the same, the current ratio will increase because the numerator is going up. And as the numerator goes, so goes the ratio. So notice that when we borrow cash long term, the net working capital, the dollar amount of working capital, that increases, and so does the current ratio. What about when we borrow short term instead of long term? What's going to be the impact on net working capital, and what's going to be the impact on the current ratio? So we're still on the current ratio, and the exam will tell you that the current ratio began, let's say, at 2 to 1. And then the company borrowed cash again. But if they borrowed $100,000 cash short term on a 9-month bank loan, then cash is going to still go up, increase current assets again, But look what's also happening. You're going to have a loan payable short term. So you're going to have a $100,000 increase in current liabilities this time. So now both the numerator and the denominator of the current ratio are increasing by the same amount. As for the net working capital, that's going to stay the same. Your current assets, your current liabilities, that's going to stay the same. But what about the current ratio when you have the numerator and the denominator both increasing by the same amount? And this is more of a math exercise than accounting. This is an analysis type question that the exam loves. So cash is going up by $100,000. That's an increase in current assets. And your short-term payables are going up by $100,000. That's an increase in current liabilities. So both your numerator and denominator are increasing by the same amount. So is the current ratio remaining unchanged at 2 to 1? Do we need algebra for this? Calculus? No. Look how easy this is going to be. Let's assume that instead of the numerator and denominator increasing by 100,000, they're both increasing by 1. Let's add 1 to current assets and 1 to current liabilities. So they told us that the ratio started 2 to 1. $2 of current asset for every $1 of current liability. If we add 1 to both sides, the current ratio goes from 2 to 1 to 3 to 2 because we added 1 to top and bottom. And when we do that, 2 to 1 becomes 3 to 2. So our current ratio, look where it is now, it's 3 to 2, which is the same as 1.5 to 1, which means the current ratio as a result of this transaction has decreased from 2 to 1 to 1.5 to 1. The ratio decreased even though the numerator and denominator increased by the same dollar amount. The absolute value of working capital did not change. The dollar amount of working capital doesn't change, but the current ratio changed. This will happen whenever the ratio starts above 1 and the top and bottom increase by the same amount. Let's try this. A company's current ratio starts at 3 to 1. If the company borrows $60,000 cash for 3 months, which of the following is correct? A says the absolute value of working capital has not changed. Is that true? Yes, because if the company borrows $60,000 cash for 3 months, you've got current assets going up and you've got current liabilities going up. So the absolute value, the dollar amount of working capital, stays the same before and after the transaction. What about B? The working capital ratio, the current ratio, has decreased. Is that true? Well, we can use that same exercise that we did where we add 1 to both sides. And the answer is going to be C. Both are correct. Why? Well, we took care of the absolute value of working capital. We said the dollar amount doesn't change. But what about the current ratio? Let's assume that instead of the numerator and denominator increasing by $60,000 cash, they're both increasing by a factor of 1. Let's add 1 to current assets and 1 to current liabilities. If we do that, we go from 3 to 1 to 4 to 2. Well, 4 to 2 is the same as 2 to 1. Therefore, the ratio has fallen from 3 to 1 down to 2 to 1. Although the absolute value, the dollar amount of working capital, has not changed. And this question asked, a company's current ratio starts at 3 to 1. If the company borrows $60,000 cash for 3 months, which of the following is correct? And the answer is both are correct. The dollar amount of working capital hasn't changed, but the working capital ratio decreased. More to do with math, not so much accounting. But it's consistent. Anytime the ratio starts above 1 to 1, if you add the same amount to both sides, which way is the ratio going to go? Down. Okay, how's it going to work if the ratio starts below 1 to 1? All right, so now the exam will tell you that the current ratio began at 0.8 to 1, which is really 0.8, and that's less than 1 to 1. That means 80 cents of current assets for every $1 of current liabilities. And here's the transaction. The company borrows cash. Well, if they borrow $100,000 cash short term, 9-month bank loan, then you have cash increasing current assets, and you have an increase in current liabilities for the 9-month bank loan. The result is that net working capital is unchanged, but what about the current ratio? Both numerator and denominator are increasing by the same amount again. Let's assume that instead of the numerator and denominator increasing by 100,000, they're both increasing by 1. So add a factor of 1 to current assets and current liabilities. So that means we go from 0.8 to 1 to 1.8 to 2. And 1.8 to 2 equals 0.9 to 1. So the current ratio has increased from 0.8 to 1 to 0.9 to 1, even though we just added the same amount to both numerator and denominator. Why? It's all because the ratio started below 1 to 1. When the ratio starts below 1 to 1, if you add the same amount to both numerator and denominator, the ratio will always increase. In this case, it was the current ratio. Next time, it might be the quick ratio or the cash ratio. Any ratio will increase if you start below 1 to 1 and add the same amount to both numerator and denominator. We know also that if the ratio started above 1 to 1 and the same amount was added to the numerator and denominator, the ratio would decrease. We saw that in the previous slide. Let's try this. A company's current ratio starts at 0.7 to 1. If the company borrows $60,000 cash for 3 months, which of the following is correct? A says the absolute value of working capital has not changed. That means the dollar amount of working capital stays the same before and after borrowing $60,000 for 3 months. Yeah, that's true, because cash goes up and so does current liabilities. Current assets up, current liabilities up by the same amount. The dollar amount of working capital, the absolute value, that doesn't change. So A, that's true. How about B? B says the working capital ratio or current ratio has increased as a result of the transaction. Is that true? Yes. Letter C, both are correct. The absolute value of working capital, the dollar amount, is calculated as current assets minus current liabilities. And since both current assets and current liabilities increase by the same amount, the absolute working capital value remains the same. So A is a correct statement. As for the current ratio, let's assume that instead of the numerator and denominator increasing by the $60,000 given in the facts, they're both increasing by 1. Let's add a factor of 1 to current assets and 1 to current liabilities. We go from 0.7 to 1, which is 0.7, to 1.7 to 2, which is 0.85. Which direction has our working capital ratio gone as a result of this transaction? Increased. The ratio is increased even though the absolute value, the dollar amount of working capital, has not changed. And this question asked, a company's current ratio starts at 0.7 to 1. If the company borrows $60,000 cash for 3 months, which of the following is correct? And the answer is both are correct. The absolute value of working capital, the dollar amount, hasn't changed, but the working capital ratio has increased. Let's try this. A company has current assets of $500,000 and current liabilities of $600,000. So it looks like that current ratio is starting below 1 to 1. The company's current ratio will be increased by, A says receiving $40,000 cash from a short-term loan. B says receiving $40,000 cash from a long-term loan. C says both will increase the current ratio. D says neither. And the answer is C, both. Since current assets are $500,000 and current liabilities are $600,000, the ratio starts below 1 to 1 at 5 to 6, which is 0.83. Why 5 to 6? Since current assets are $500,000 and current liabilities are $600,000, we can say that there's $5 of current assets for every $6 of current liabilities. 5 to 6, which is below 1 to 1 and translates to 0.83. That's where the working capital ratio is starting. Now in choice A, receiving $40,000 cash from a short-term loan increases both cash and current liabilities by the same amount. So current assets and current liabilities are going up by the same amount. So we can then add 1, which is the same amount to both the numerator and denominator, and go from 5 to 6, which is 0.83, to 6 to 7, which is 0.86. And that's an increase in the current ratio from receiving cash from a short-term loan, but it's all because the ratio began below 1 to 1. We know that in letter A, they received $40,000 cash from a short-term loan, and now we know that that's going to increase the current ratio because it began below 1 to 1, but it's not going to increase the net working capital dollar amount. That'll stay the same. Now, choice B, receiving cash from a long-term loan increases the numerator of the current ratio, current assets, without any impact on the denominator of the current ratio. Numerator up, ratio up. Thus, the current ratio increases for receiving cash from a long-term loan. And in choice B, it made no difference whether the ratio began below 1-to-1 or above 1-to-1 because we did not add the same amount to both sides. We only added to the numerator without any impact on the denominator. And as numerator goes, ratio goes. So numerator went up, ratio increases. Note that both increases in cash increased the current ratio. So whether we increased cash for a short-term loan or we increased cash for a long-term loan, they both increased the current ratio, but for different reasons. And that's why I don't want you to memorize this. You need to be able to analyze it. The same way we do it here. Use the factor of 1 if the numerator and denominator are increasing by the same amount. We did that in choice A. Don't use the factor of 1 if the numerator and denominator are not increasing by the same amount, like in choice B. All we had to do here was notice that the numerator was increasing and the denominator was remaining the same. There's too much here to memorize. You need to recognize, attack it, and then move on. What I-75ers refer to as the RAM method. Recognize, attack, move on. Let's try this. If a company has a current ratio of 3-to-2 and pays off a portion of its accounts payable with cash, which of the following is correct? And if you think you know, leave me the answer in the comments section. And if you're struggling with the CPA exam, EA, or the CMA exam, and you found this video helpful and want to see the rest of it and more videos like it, get yourself on I-75 with me, Darius Clark. I'll leave a link in the description. I-75 is the only material that you'll need to pass the CPA FAR exam. And if you already have one of those big boxy CPA review courses, but it's not fitting your learning style, I think you'll notice the I-75 difference right away. Go to i75cpareview.com and get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference.